Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: What is an economic crisis? An economic crisis can be understood as a situation where a country experiences a sudden downturn in the economy, which can manifest through various indicators such as declining gross domestic product, rising unemployment, falling asset prices, and financial instability. Economic crises can result from a variety of factors, including but not limited to systemic failures, market bubbles, government policy decisions, and external shocks. Understanding the complexity of economic crises requires examining both historical examples and theoretical frameworks that explain their occurrence and impacts. One of the most illustrative examples of an economic crisis is the Great Depression, which began in 1929 and lasted through the late 1930s. This period was marked by a dramatic decline in economic activity, with global GDP falling by about 15%. The stock market crash of October 1929 is often cited as a critical trigger, but underlying factors included overproduction in agriculture, high levels of debt, and significant income inequality. The failure of banks and financial institutions exacerbated the crisis, leading to widespread bank runs and a collapse in consumer and business confidence. Economic crises can also take the form of financial crises, characterized by the rapid devaluation of financial assets and the failure of financial institutions. The 2008 financial crisis serves as a recent example. Sparked by the collapse of the housing bubble in the United States, the crisis quickly spread globally due to the interconnected nature of modern financial systems. The widespread use of complex financial instruments, such as mortgage-backed securities and credit default swaps, amplified the crisis. As housing prices fell, these financial products lost value, leading to massive losses for banks and investors. The crisis resulted in a severe credit crunch, where lending dried up, further hampering economic activity. Government policy decisions can also play a significant role in either precipitating or mitigating economic crises. For example, austerity measures, policies aimed at reducing government deficits through spending cuts and tax increases, can sometimes exacerbate economic downturns by reducing overall demand in the economy. During the European debt crisis that began in 2009, several countries, including Greece, Portugal, and Spain, implemented austerity measures as a condition for receiving financial assistance from international organizations like the International Monetary Fund. While these measures were intended to restore fiscal balance, they also led to significant economic contractions and social unrest. External shocks, such as natural disasters, pandemics, or geopolitical events, can also trigger economic crises. The COVID-19 pandemic, which began in late 2019, is a prime example. The pandemic led to unprecedented global economic shutdowns as countries imposed lockdowns to curb the spread of the virus. The resulting disruption in economic activities led to a sharp decline in global GDP, with the International Monetary Fund estimating a contraction of 3.5% in 2020. The pandemic also highlighted the vulnerabilities in global supply chains and the importance of healthcare systems in maintaining economic stability. Economic crises have far-reaching impacts that extend beyond immediate financial losses. Social consequences often include increased unemployment, poverty, and inequality. For instance, during the Great Recession following the 2008 financial crisis, the unemployment rate in the United States peaked at 10% in October 2009. Long-term unemployment can lead to skill erosion, making it harder for individuals to re-enter the workforce even after economic conditions improve. Additionally, economic crises often strain public resources, leading to cuts in essential services like education and healthcare, which can have lasting effects on human capital development. The psychological impact of economic crises should not be underestimated. Financial instability and job loss can lead to increased stress, anxiety, and mental health issues. Studies have shown that economic downturns are associated with higher rates of depression and suicide. The social fabric of communities can also be affected, as economic hardship often leads to increases in crime and decreases in social cohesion. Addressing economic crises requires a multifaceted approach that includes both preventative measures and responsive policies. Regulatory frameworks that ensure the stability of financial institutions and markets are crucial. For example, the Dodd-Frank Wall Street Reform and Consumer Protection Act, enacted in response to the 2008 financial crisis, aims to reduce risks in the financial system by increasing transparency and accountability. Additionally, central banks play a critical role in managing economic crises through monetary policy. By adjusting interest rates and implementing unconventional measures like quantitative easing, central banks can influence economic activity and stabilize financial markets. Fiscal policy is another essential tool for managing economic crises. During downturns, government spending can stimulate demand and mitigate the negative effects of reduced private sector activity. The economic stimulus packages implemented by various governments during the COVID-19 pandemic, which included direct payments to individuals, unemployment benefits, and support for businesses, exemplify the role of fiscal policy in crisis management. International cooperation and support can also be vital in addressing economic crises, particularly for developing countries that may lack the resources to respond effectively. Organizations like the IMF and the World Bank provide financial assistance and policy advice to countries facing economic difficulties. However, the conditions attached to such assistance, often requiring structural adjustments, can be controversial and may not always lead to the intended outcomes. In conclusion, economic crises are complex phenomena with multiple causes and far-reaching impacts. Understanding these crises requires a comprehensive approach that considers historical examples, theoretical frameworks, and empirical evidence. Effective management of economic crises involves a combination of regulatory policies, monetary and fiscal interventions, and international cooperation. By learning from past crises and adapting policies to current conditions, it is possible to mitigate the adverse effects and build more resilient economies. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.